Welcome everybody, my name is Scott Crace. I am the founder and president of a fee-only fiduciary wealth management firm called Crosspoint Wealth. Today we're bringing you another blog article and video from our particular blog that we have. Common Financial Sense, as you see right here. What we're trying to do is just bring a little common sense to a complicated financial landscape. So let's get right to it. The title of this is 6 Different Ways You Could Lose Money in Bond Funds. Now, bond funds are a big investment for people approaching retirement, already retired. In 401k plans, it's virtually one of those asset allocations that virtually almost everyone has. So really, we wanted to dig into and have you understand the different ways you could lose money in bond funds. So really, do you use bonds for income? Do you think that they're really safe? And yeah, I'm asking, do I really want to talk about losing money? And the answer is yes, because you want to be more educated and informed to potentially not have that happen to you. So this article is how to potentially avoid losing money, especially if you are approaching retirement or already retired. The problem is investors think, I'm okay. And I hear that a lot. I'm okay. Or if interest rates go up, it won't really affect me, so I think I'm okay. And the reality is they don't want to take the time or the energy or the effort to just take 1 or 2 more simple steps to talk to somebody to get a second opinion so that the worst doesn't happen for them. Well, guess what happened? Do you even remember what happened in 2008 in the financial crisis, right? So those people that thought they were okay and were complacent were not. And specifically, the financial markets went down, including bond funds. And that's something that we want to avoid going forward. So really bond funds and income funds. Let's get into some of these really specifics. What is a bond fund? Bond funds and income funds are terms used to describe a type of investment company, mutual fund, closed-end fund, unit investment trust, UIT, that invests primarily in bonds or other types of debt securities. Depending on its investment objectives and policies, a bond fund may concentrate on investments in a particular type of bond or debt security, such as government bonds, municipal bonds, corporate bonds, convertible bonds, mortgage-backed securities, zero-coupon bonds, or a mixture of types. The securities that bond funds hold will vary in terms of risk, return, duration, volatility, and other features. Do you still know your bond funds? And that also goes with exchange-traded funds as well. Let's just continue. So I hear, wait, I can even lose money in bond funds? And the true answer is yes. A common misconception among investors is that bonds and bond funds have little or no risk. Like any investment, bond funds are subject to a number of investment risks, including credit risk, interest rate risk, and prepayment risk. A bond fund's prospectus should disclose these and any other risks. Before investing in a bond fund, you should carefully read all the fund's available information, including its prospectus and most recent shareholder report. Or you could also work with a financial advisor to help you do that. Now, you could lose money in bond funds. So the number one way is credit risk. So according to the businessdictionary.com, the probability of loss from a debtor's default. In banking, credit risk is a major factor in determination of interest rate on a loan. Longer the term of the loan, usually the higher the interest rate. Also called credit exposure, also known as the issuers of the bonds owned by a fund may default. This risk may be minimal for funds that invest in U.S. government funds. All right, the second type is interest rate risk. Remember the cardinal rule of bonds. When interest rates fall, bond prices rise. And when interest rates rise, bond prices fall. So interest rate risk is the risk that changes in interest rates in the U.S. or other world markets may reduce or increase the market value of a bond you hold. Interest rate risk, also referred to as market risk, increases the longer you hold a bond. So let's take a little look at some of the risks inherent in rising interest rates. So here's an example. If you bought a 10-year 1,000 bond today at a coupon of 4%, and interest rates then rise to 6%. If you need to sell your 4% bond prior to maturity, you must compete with newer bonds carrying higher rates. This higher coupon rate bonds decrease the appetite for older bonds that pay lower interest. The decreased demand depresses the price of older bonds in the secondary market, which should translate into you receiving a lower price for your bond if you need to sell it. In fact, you may have to sell your bond for less than you paid for it. That is why interest rate risk is also referred to as market risk. All right, so rising interest rates also make new bonds more attractive because they have higher coupon rate. This results in what's known as opportunity risk, the risk that a better opportunity will come around that you may be unable to act upon. The longer the term of your bond, the greater the chance that a more attractive investment opportunity will become available, or that any number of other factors may occur that negatively impact your investment. This is also referred to as holding period risk. The risk that not only a better opportunity might be missed, but that something may happen during that time you hold a bond to negatively affect your investment. All right. Bond fund managers face the same risks as individual bondholders. So a lot of you right now currently own bond mutual funds, and that portfolio manager faces similar risks. So when interest rates rise, especially when they go up sharply in a short period of time, the value of the fund's existing bonds drop, which can put a drag on overall performance. Please remember that. Another way to think about it as interest rate risk is the risk that the market value of the bonds owned by a mutual fund or ETF will fluctuate as interest rates go up and down. For example, when interest rates go up, the market value of bonds owned by a fund or ETF will generally go down. Nearly all bond funds are subject to this type of risk, but funds holding bonds with longer maturities are more subject to the risk than funds holding bonds with shorter maturities. Because of this type of risk, you can lose money in a bond fund, including those that invest only in insured bonds or U.S. government bonds. Number 3 is lack of liquidity. This is a good one. Liquidity risk is the risk that you will not easily be able to find a buyer for a bond you need to sell. A sign of liquidity, or lack of it, is the general level of trading activity. A bond that is traded frequently in a given trading day is generally more liquid than one which only shows trading activity a few times a week. So-called safe investments faced a lack of liquidity in 2008. It's no secret that the Securities and Exchange Commission, SEC, has been and is concerned about the bond fund and mutual fund liquidity. So Zach Zemansky writes in SeekingAlpha.com, right now, the issue on the minds of many in the market is liquidity, or simply the ability of a seller of a stock or bond to find a buyer. Without liquidity, markets plummet, as they did in 2008 and early 2009. Liquidity is all important to investors. It's oxygen to markets. Wow, it's oxygen to markets. That's a powerful statement. And I also wanted to share some information or a quote from Dr. Nouriel Roubini, aka Dr. Doom. This combination of macro liquidity and market illiquidity is a time bomb. Roubini contends, so far it has led only to volatile flash crashes and sudden changes in bond yields and stock prices. But over time, the longer the central banks create liquidity to suppress short-term volatility, the more they will feed price bubbles in equity, bond, and other asset markets. As more investors pile into overvalued, increasingly illiquid assets, such as bonds, the risk of long-term crash increases. So those are just two areas of concern when dealing with bond funds. Number 4 is prepayment risk. Prepayment risk is the risk that issuers of the bonds owned by a fund will prepay them at a time when interest rates have declined. Because interest rates have declined, the fund may have to reinvest the proceeds in bonds with lower interest rates, which can reduce the fund's return. Not all bond funds, however, can be prepaid. And number 5, reinvestment risk. According to investinginbonds.com, reinvestment risk is when interest rates are declining, investors have to reinvest their interest income and any return of principal, whether scheduled or unscheduled, at lower prevailing rates. In a certain type of bond, like a callable bond, you might not receive the bond's original coupon rate for the entire term of the bond, and it might be difficult or impossible to find an equivalent interest-paying rate as high as the original rate. This is known as reinvestment risk. Additionally, once the call date has been reached, the stream of a callable bond's interest payments is uncertain, and any appreciation in the market value of the bond may not rise above the call price. And number 6, there's been a lot of interest, marketing efforts towards ultra-short bond funds, whether it's mutual funds or ETFs. So number 6, you can lose money in ultra-short bond funds. So let's dig into that one. Ultra-short bond funds are mutual funds or ETFs that generally invest in fixed income securities with extremely short maturities or time periods in which they become due for payment. Like other bond funds, ultra-short bond funds may invest in a wide range of securities, including corporate debt, government securities, mortgage-backed securities, and other asset-backed securities. Some investors just don't realize that there are material differences between ultra-short bond funds and other investments with relatively low risks, such as money market funds and certificates of deposit. Specifically, ultra-short bond funds tend to have higher risks than money market funds and CDs. So let's wrap this up with a little bit of a summary. Understanding bond risk is extremely important because you face the risk that you might lose money. And if you're approaching retirement or already retired, you want to avoid those risks of losing money, and it's a double negative if you're losing money and withdrawing assets on that to live on. So if you're approaching retirement or already retired and you need some help with your portfolio to clearly see how much risk you hold or how much volatility you actually have without even knowing it, schedule a brief phone strategy session with CrossPoint Wealth by clicking that little link right there. Thank you for listening. Thank you for reading. We appreciate your time. If you know of anyone that might benefit from this information, family member, friend, a coworker, someone in your networking group, please pass that information along. Until next time, Scott Crace with CrossPoint Wealth.